So what we're going to do today is go through one of the things they always do at family reunion, which I think is really valuable, and I'll be the first to say I think some people love it, and some people it makes their head hurt. But I would argue it's really important, and that's Gary Keller's vision speech. Now, I would argue Keller's vision speech is less of a vision speech and more of a state of the economy presentation. But it is all the data, all the stats, all the projections. It's what's happened and what do we think is going to happen. And I think what's really important about that is we have to acknowledge the fact that our consumers have more information available to them than they ever have in history, right? That's just the nature of the world we live in is we have way more access to information than what we used to have. Well, it behooves us to know more about real estate than our clients know, right? So where just knowing what's for sale and what the average sales price is or the average days on market, like that used to be enough to know more than our consumer. And I would argue today that's not enough to know more than our consumer, right? And if we're serious about our careers and our goal is really to be like the real estate economist of your local market, then we got to learn stuff, we got to study stuff, and we have to know things that our consumers don't know. I think the other part of it that's really important is a lot of times usually once a year I'll do a presentation that is reality versus stories, and it's basically here's all the stories that are spinning out there in the market, whether it's in agents' heads and vocabularies or whether it's in our consumers' heads or vocabulary, and then here's the reality of those stories, right? So stories tend to be built around how we feel. Reality tends to be built around facts that can be supported with data, right? So we need to know those, right? Because if the consumers have stories and we just accept those stories, then we're not really being a consultant, right? We actually have to be able to script those stories down and bring reality to the conversation, right? A really good example of that is as the market went ballistic in Connecticut, which is where I am. You heard the bubble conversation all the time, like this can't last, this is crazy. Like, when do you think the bubble's going to burst, right? Because what people saw was double-digit appreciation. What people didn't know is that we went a massive, basically from the banking crash to the pandemic, Connecticut had little to no appreciation. Right, everywhere in the country, when the banking crash hit, prices dropped like a rock. As things recovered, prices started to recover predominantly across the country, right? Different in different pockets, but predominantly at a historical norm of about 4% a year. Connecticut just never saw that, right? So we just kind of crashed, and then for some reason we got comfortable and hung out at the bottom, right? It wasn't until the pandemic hit that prices started appreciating. So what was interesting is we were well into the pandemic market with double-digit appreciation. And if you actually tracked the appreciation, while people were saying that these prices are out of control, if you just applied 4% appreciation a year compounding from the bottom of the crash, what we really found is when that conversation started, we were still underpriced. Right. And then that conversation continued, and eventually it was still the story, but that appreciation had just met where it was supposed to be if we had just gotten 4% annually. So the simple part of that conversation is we got 15 years of our appreciation in 2 years. So it felt insane when the reality was we were right where we should be. But without knowing the numbers and being able to educate them, the story dominates the headlines. Michael, I see you putting your hand up.
Yeah, I'm close to you here, just outside of Boston, Massachusetts, and we didn't stay flat. Why do you think your area of Connecticut stayed flat?
Yeah,
You
it's a little bit of a conundrum. I think predominantly it was lack of job growth and declining population.
and you're in Hartford or outside Hartford?
I mean, we cover the whole state of Connecticut. Uh,
Okay.
Predominantly all of Connecticut outside of Fairfield County. Fairfield County is kind of outside of our territory. So most of Connecticut,
Is Fairfield
predominantly Hartford.
on the edge of New York?
It is. And it's,
Okay.
for all intents and purposes, you could call Fairfield County New York. It
Yep.
has
Okay.
more, it is impacted more by New York than
Than
it is
Greenwich.
by Connecticut. Correct.
Okay.
Yep.
And that would make
So,
sense. Okay.
yeah, exactly. All right, so let's dive into the numbers. So I'm gonna share screen here. We've got an hour down to 51 minutes to cover what was covered in 90 minutes at Family Reunion. So we're going to focus on the pieces that matter the most, go reasonably quickly. Drag you guys where I can see you all. Okay. All right, let's go by the disclaimer. So, number one, home sales. This is what it looked like. This is our historical data all the way back to 1990. Last year, 2025, we did 4.1 million transactions. Obviously, if you look at that, 3 years running, we did 4.1 million transactions, right? So if you look at the entire trend, number one, you have to go all the way back to the 90s in order to see a 3 year run where we did less transactions. If you go back to the banking crash, which you see in 2008, that's where the banking crash in most markets really started. The reality is it started percolating in 2006. But depending on where you were, some places it took longer to really have an effect than others. But it was that whole '06 to 2010 range was where we were living in that banking crash environment. But we had a 3 year run of 4.1 million units that dropped from a peak, which you really, in my opinion, have to strip that year out, which was 2021. That was the peak of the pandemic market, right? There's no other way to talk about it. The truth of the matter is, during that time frame, we drove rates down so low that we were borrowing future buyers, if you will. We were pulling people into the market early. And the second thing we were doing was locking people into their houses with interest rates so low that it made it a very difficult mathematical conversation to convince anybody to move, right? So the truth is, we cured short-term pain and caused long-term pain. That's just the fact. But this is what the trend looks like. Now, 2026, they're predicting a slight uptick. They're thinking we're going to land around 4.3 million. If I'm you, I'm paying attention month by month as to how those numbers track in my market. I can tell you in Connecticut, January was down, February was up. Not by a lot, but January was down by about 0.7%. February was up by 5 point something percent in Connecticut, right? Those are just 2 months. Another thing to think about when you're looking at stats, at some point, somebody taught me when you're looking at stats, when you see a shift in numbers for a month, that is an anomaly in that moment in time. When you see it for 2 months, it's a pattern. When you see it for 3 months, it tends to be a trend. Meaning you might see an uptick in something for a month, like February. February right now in Connecticut, closed sales were up I think it was 5.67%, I believe was the number. That doesn't mean a whole lot to me. It's 1 month. However, if March lands in that range, okay, well, now I'm starting to see a trend. If I get 3 months of that in a row, it's starting to look like a pattern. Like, I'm sorry, it goes singular event to pattern to trend. You see 3 months, that's starting to tell you that's the direction that we're moving in. So just a little insight to take a look at. But right now they're predicting 4.3 million, which is a small uptick that none of us will likely feel in our businesses. It is a small enough uptick. What we're going to feel is that feels an awful lot like last year, right? The good news is it is stabilization, right? Seeing a little bit of an uptick in the right direction is a positive thing. Home sales by month, right? This really just gives you your seasonality. We all know in New England, we absolutely do have seasonality based on our winter months. This one I think is definitely very important. So home prices, again, lots of conversation about houses being unaffordable and all the things. Strictly from a what is a home cost in the United States, Now, again, everything we're talking about is the United States. What you have to know is if you don't know the answer to one of these slides for your local market, then you should have a pad next to you, and that's your homework, right? If you don't know what the average sales price is in your market right now, then you should be logging into MLS after this to find out. Number two, you should be looking at how high that is above the trend, right? The trend marks 4% annual, right? If you go back to the 90s, that is your typical appreciation is about 4% annually. So any appreciation above 4% is above the average or the median across history. So you should know what the average sales price is, and you should know how much higher is that than standard 4% appreciation, right? That gives you an idea when you hear somebody tell the story, home prices are just out of control. My question is always, is that 100% true? And then my next question is, well, what data would I have to go look at to find out if it is in fact 100% true? Because it's not our job to deny reality. It's our job to shine a light on reality, right? So we just have to know, is it an accurate statement or is it not, right? So as of right now, nationally, we are 7.4% above the trend at 4%, okay? This just shows you your home pricing appreciation annually, again, all the way back to 1990. And here's the thing that's important, right? Whether you're a data person or not, and I probably should say I am not a data person by nature. I was taught to be a data person, right? So like today, I would say it's my nature to look at data. I just want to be super clear. I wasn't born a data guy. I didn't even enter real estate a data guy. I just entered real estate a guy. And then somebody taught me how important data was. And I decided I should probably learn how to understand data because it makes me smarter and better at what I do. Right. So I think it's really healthy to, when you look at history, history predicts the future. Right. We as human beings have very, very short memories. Right. So things happen and we act like, oh my gosh, I cannot believe this happened. This is unheard of. Well, typically you can go back in time. It's already happened. And if you knew that ahead of time, not all the time, but often, you actually would have seen it coming, right? Because there's trends. So this just kind of shows that appreciation. Again, you see that giant dip where prices peaked with an increase annually of 12.4%. That was right before the banking crash kicked in. Again, as I said, depending on where you were, that was 2006 to 2010 that you were living in it and feeling it. And you can see the massive drop in pricing. Again, that is a thing that was a huge impact on the market. You can see we went from appreciating by 12.4%. The following year, we appreciated by 1, then lost 1.3, then lost 9.5, then lost 12.9. That was the story of that time. People's home values were dropping like a rock, right? Which caused them to be upside down on their mortgages and yada, 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 right? But you can see that trend there. Then we came out of that. It was around 2012 that we started to see appreciation again. We had a really great run. If you were in real estate from 2012 to 2019, it was a wonderful time to be in real estate. It was very steady. It was very healthy. We may or may not have known how great it was while we were in it, because sometimes you have to get shaken out of it to recognize. Then the pandemic hit. We had that insane borrowing from the future, increase in transactions, values, all the things, right? And then we see that drop off here. What we're seeing now is nationally appreciation is actually below average, right? So we went from the peak of
No,
appreciation.
he's not funny about that. Why is he chasing you, like, what's wrong with
Hey, Angel, Angel, can you mute? Angel, Angel, you got to mute while you're turning wrenches, buddy. Thank you. I love that you're on the call, even though you're turning wrenches. You're getting it done. I appreciate that. All right. So you can see the trend there. We peaked at 18% appreciation in a single year. Then we dropped all the way down to 2023, not even a full percent. Then we bounced up to 4.7. Then we dropped down to 1.7. So we're actually below the trend mark right now nationally. Now, if you look regionally, You look by state, you look by town, you're going to find different flavors, which is why it's important for you to know and understand these numbers in your local market. What I can tell you is the Midwest and the New England region are the regions that are still showing appreciation at a higher than normal level, right? New England is still experiencing a shortage of inventory. We're still experiencing very short days on market, and we're still experiencing appreciation that is predominantly exceeding the national average of 4% a year. But we're absolutely seeing it cool down. Other parts of the country, most of the country has already cooled. Their inventory is significantly up, which we're going to look at. So again, this is just another representation of home prices. As I was looking at these slides before I got on the call, one of the things that I found very interesting is, a lot of what is going to influence our market in a positive direction, increasing the amount of transactions that take place, is interest rates, right? And we're going to dive into interest rates. What I did find interesting, though, is one of the question marks that could impact what interest rates do in 2026 is geopolitical instability, things going on all around the world. I find it a little bit fascinating and something to pay attention to, not worry about. I wouldn't necessarily get into dialogues with my clients about it. This would be one of those things that I'm just kind of paying attention to and going, this could end up looking like that. I'm going to keep an eye on this. If you go back to, let's see, 1972, 1973, the oil crisis, which led to the stagnation in the mid 70s, which led to a collapse in 1982. That story looks a little bit like a story that is developing right now. Right? We have a conflict going on that is restricting oil supplies that does not have to go on for very long before it has a massive economic impact. So that is something to pay attention to, because what is happening there is not terribly dissimilar from what happened back then. And you can go back in history and see what happened to our industry when all those things were taking place. Now, fingers crossed, that's a conflict that gets resolved quickly and we get back to some version of normal, but something I would be paying attention to, not necessarily talking about with clients, but paying attention to. Total market volume. I mean, this is the darling of the story, despite how challenging inventories have been and how significant the number of units has dropped. The reality is the increase in sales prices have backfilled that hole. So the thing that our industry gets compensated on, which is the value of the home, because they are historically high, it has backfilled some of the hole of having less units to do. So you can see total market volume. We were at 2.25 million, right? The last 3 years, that 3-year stretch, we bounced right around 2 million to 2.25 million. They're predicting 2.4 million for 2026. So again, slight uptick. So that's a combination of they're expecting a little bit more units to happen and they're expecting a little bit of appreciation to show up. Those two things combined, they're predicting 2.4 million. Right? If you go back and look at the history, you can kind of see your trends. We've got the 2021 that in my mind always has to get stripped out of the data because it's an anomaly, right? It's a year that was completely influenced by a thing most of us have never seen before, which was a pandemic. So you kind of have to strip that out of the data. If you go back and look at the volume, when you take that out of the picture, we're looking at the last 3 years being 3 of the highest volume years in history. Now, the other thing that is a little interesting when you look at those trends, there's another piece of data in this slide, which is aging population, right? So you go all the way back to 1999. There was 761,000 licensed real estate agents. Now, to be clear, there is a massive chunk of the agent population that carries a real estate license, but does not practice, right? So when we talk about the number of real estate agents, those are the people who hold the license. That number by 2006, just 7 years later, had gone up to 1.36 million. Now, why did that happen? I mean, we basically doubled the agent population in a very short period of time.
It was easy.
There you go. The market went bonkers. The news said the real estate market is crazy. Houses are selling like crazy. And what is everybody? Human nature. Human nature, unfortunately, is people look for easy opportunities, and there is no such thing, right? Which is why when you look at the trend line, you actually see the agent population follows the trend a bit, right? It's always a hair above it, but it follows the trend, right? That is all the fair weather real estate agents. They get in when the market's good, they get out when the market's bad. Now, the good news for everybody who's a full time real estate agent, yes, those fair weather agents, right? When that herd thins and you stay focused on your core business and your career, you capture market share. This is the reason why, if you go into the banking crash, right? I was new to leadership at that time and fairly new to real estate. I was running an office, had been in real estate for a handful of years. And, I was surrounded by salty dogs, though, people who had been in it longer than me, who had history and understood cycles and crashes that had come in the past. And they would always talk about the bell curve. And that was when the market dipped, you had agents who got out and agents who put their head down and did the work. And the agents who stayed in, when they came out the other side, they came out with massive progress, right? And then I watched it happen in my office. My top producing agents went into the banking crash $5-6 million producers. They came out the other side 25, 35, $40 million producers because they were the ones who put their head down and took market share while everybody else was looking for some multi-level marketing juice company or travel company to try to replace their real estate revenue. So point in that is you just got to decide, are you in it or not? The ones who are in it, they take market share in hard markets. So when the market's hard, you should actually be grateful for the hard market because that's when the herd thins and that's when you take market share if you're a true professional. Doesn't mean it's fun being in it, but you got to be in it doing the work, knowing this work gets me to the other side with far more market share than I went in. So I'm grateful to be in it. Right. So anyways, you can see the trend there. And again, they're predicting 2.4 in total volume for 2026. So a slight uptick there. Inventories, again, you got to know your own numbers. You can see as a country, we dropped all the way down to 2.2 months worth of inventory. Right now, nationally, we're up to 4.2. I can tell you in Connecticut, we're still down around the 2.2 range. I actually looked this morning before we got on this call. At the end of 2016, we had 27,000 homes on the market. We have 6,600 on the market in Connecticut right now. 27,000 to 6,700. Right. So Connecticut market is different than what's happening nationally right now. We're very much still in that restricted market, but you need to know what's going on in your market. Are you still in New England as a whole? Our month's worth of inventory is typically lower than what is happening nationally because, again, we're behind the curve right now. Okay. By the way, a little tip that tends to be the trend, right? One of the things I always say is you have windshield markets. Your windshield markets tend to be your Florida, your Arizona, your Texas. I used to say California, but now I feel like you can't really track what's going on in California. I don't know if that's a fact, but I feel that way. But there's certain markets that do everything first and do it really big. I would argue Florida is the most obvious. Everything almost always happens first in Florida and happens really big. They boom big, they crash big, and they're usually first to the party. New England is the exact opposite. We're the last one to the party and we don't party as hard. So if you pay attention to those windshield markets, you usually have a pretty good idea of what's coming. We're usually 18 to 24 months behind, right? So when you start to see everything shifting in places like I just mentioned, arguably you might be able to put the Carolinas in there, although they tend to be a little bit more stable because there's still a lot of folks moving in those areas. But if you watch those markets, you'll generally have a pretty good idea of what's coming down the road. And here's why this is important. Besides being a professional and knowing more than your clients know, besides being able to have intelligent, informed, data driven conversations to ensure your clients aren't buying fiction, this is also how you business plan. This is how you see, this is how you have a competitive advantage in the real estate market because you see trends coming and you pause and go, okay, well, if that's happening here, how would I change my business strategies when it shows up here? And then you start doing that before it actually shows up. Right. A good example as an agent, I was an agent when the banking, right before the banking crash started. There were signs that was coming and they weren't very quiet. Like you just had to take your headphones off and turn the stereo down for a second. Like it, no one should have been surprised by that. The signs were there. It's just everybody was having such a good time. Nobody wanted to slow down and listen to it. I was lucky enough to see that coming and made business adjustments before it showed up in the market. And when it did show up, it turned out to be an advantage for me rather than a disadvantage because I had put myself in front of REO. I had learned how to do short sales when nobody knew what a short sale was because I believed that was going to be the market of the moment very, very soon. And it turned out to be accurate. So this is the advantage you get when you learn how to look at data and you look backwards in order to figure out what's coming in the future. So again, inventory right now, again, Connecticut, I know we're still sitting about 2.2, 2.1, somewhere in that range. It might be 2.3. You should know this for your market. Nationally, we're up to 4.2. Somebody tell me, what do they consider a balanced market? What's the happy? What's the balance? Somebody knows. Angel, take a guess. Can you hit on mute and take a guess? What's a balanced market? How many months of inventory is a balanced market? I probably should have picked someone else. He's driving.
4 to 5 months ish.
So the general rule of thumb has always been 6 months. 6 months is completely balanced. 6 months of inventory is not a buyer's market. It's not a seller's market. They consider it a balanced market. So that's generally been the rule of thumb. Right now, we're at about 4.2 nationally. Again, I know there's pockets where it's going to be very different, where it might be higher, lower. New England as a whole, you're probably going to find is lower than that still right now. But again, you got to know those numbers. We know basic supply and demand. If there's more demand than supply, typically prices rise. If we have more supply than demand, then prices tend to go down, right? That's a basic law of economics that generally rings very true. So then we go to mortgage, right? This is sort of like, we like to think of this as the devil in the conversation. Here's an interesting thing. And again, this goes back to the more you look at history, the more you recognize patterns and trends. I was at an event where they were going through these economic numbers, and this was when the rates were still down, probably somewhere in the 3.5-ish. I want to say maybe it was 2020, 2020, early 2021, somewhere in that ballpark. But inflation was going crazy. I think at the time, if I remember right, inflation was close to 8. Like it was extremely high, 7.8 or something like that. But as they were showing graphs and data, what I realized is, so we know that the Fed uses interest rate to try to cool inflation. So if inflation is going through the roof, they tend to raise rates, right? They're trying to calm that inflation down. And essentially what they're doing is making things more expensive so that they can drive the inflation down, right? Increase the cost of money to all of us so that it affects our behavior, and that brings down the temperature on the inflation. But when I looked at the charts, I realized if you put them over, and by the way, if you're an economist, this is probably common sense, and you're like, wow, they probably would have looked at me and said, how do you walk the planet and not know that? But I didn't know it. But I realized that if you put them on top of each other and looked at the historical patterns, the interest rate had to meet inflation in order for it to do its job. In other words, you bump up the interest rate a hair and inflation is still way up here, it doesn't do the job. It actually they have to meet before you start to see the results. So when we looked at that, I said, holy cow, look at this trend. I was like, if according to history, We have to get to almost 8% interest before it's going to do its job and bring inflation down. And everybody at the table said, could you imagine if that happened? And I said, well, the interesting thing, history says it's absolutely going to happen. And everyone, but it felt unbelievable at the table, sitting in that moment with rates where they were. And guess where rates went? We all know now, right? Rates went all the way up to a peak of like mid sevens to high sevens. Well, looking at history, you learned, oh, in the past, this is where rates got to in order to have that effect. And sure enough, that time ended up looking just like this time, right? That was a thing I did not know, did not understand until I saw that data and said, wait a minute, there's a pattern here. And if history is correct, this is what's going to happen in the future. And sure enough, it did, right? So if we look at rates, here's the trick with rates, okay? If you go back 30 some odd year average all the way back to 1972, the average interest rate is 7.72. Okay. The challenge is that if you look from 1990 to today, the average is 6%. So for most of us, the portion of life that we can remember and the portion of life that of folks who are buying and selling houses, the majority of that population, their perspective is 6%. They lived in a world that was sub 6% most of their life. I mean, if you look at that, even going back into the 90s, you know, we saw rates above that in the early 90s. Once you got to the 2000s, we were at, and then once you got to 2008, from 2008 to today, which is almost 20 years, all anyone has experienced is sub 6% mortgages. Right. So that has created the perception that when we get to 6.5, people think the rates are insane. If you go to an even younger population, right, who was just entering the home buying, who saw 2.5, 3.5% interest rates, 6.5 sounds like completely absurd. It sounds like loan sharking. So the point is there's perspective there that we're battling, and it's a big part of what is absolutely hindering the market right now. So predictions right now in 2025, we sat about 6.6 as an interest rate. Obviously, that gets affected by the borrower, the product, all sorts of different things. But 6.6 for 2025, they're predicting 5.9. They're thinking that's where we will get to in 2026. Not a huge adjustment. I do believe anything with a 5 in front of it is a positive. This whole time in my head and out loud, I've been saying I think we need to get to 5.5 before the rate actually starts, before consumers start making life decisions instead of rate decisions. Meaning, I know it's time for me to downsize, or I know it's time for me to upgrade, but I just don't want to trade the rate. My belief has been if we get to 5.5, and that's just my belief, it's not a fact. My belief is if we get to 5.5, that's around the range where people will start making life decisions instead of rate decisions. So
Matt,
go ahead.
the other part of that though is will that, if we get to 5.5 or lower, we still need the inventory.
Correct.
Now, some of those people that are stuck in a 3 point something might say, okay, finally, I can pull the trigger. It's 5 something, but we still need the inventory.
So
And
I'm sorry, keep going.
that could open the floodgates, and then we're back to bidding wars again.
Yes. So this is why it's going to be an interesting, excuse me, an interesting transition. You know, we're coming out of a market that's different than what we've seen before. The banking crash was also something that we had not seen before in our lifetime. But our biggest challenge is inventory. There's only two things that can solve inventory. Rates drop to a place that people start listing their house because they can make financial sense of it, or B, new construction. New construction is not going to save the day in New England. It is just not going to happen. right? We don't build enough houses in New England for lots of reasons. That could be an entire 1 hour conversation. We don't build enough houses in New England to solve the problem, period, end of story. New construction is not going to solve our problem. We've got to bank on rates. We've got to bank on rates getting to a point where people decide they're actually willing to sell, which frees up the inventory, right? That rates are going to have to allow buyers to go, okay, I'm okay with the cost of owning a home, and sellers to say, I'm okay with the cost of transitioning to a better home for me. And that's when we're going to start to see inventory climbing, because new construction is not coming to save the day for us in New England. Just isn't happening. And by the way, new construction right now in areas where new construction is big are cooling, because those markets are cooling, right? I referred somebody to purchase a property in South Carolina recently, talking to the agent. I said, I'm guessing it's a buyer's market there right now. Is that accurate? And he said, oh, yeah, it is. He said, let me tell you, 18 months ago, 24 months ago, builders didn't even want to pay agents commissions because they didn't think they needed us. Now we're getting emails on Fridays where they're running sales. They're running closing bonuses, like, right? So construction in those areas is starting to slow down. But again, for us, that's not going to be the answer. Again, this is just kind of a different visual that shows you some of those historics. This is where we really shot ourselves in the foot when we allowed rates to go down sub 3 and into the threes. For those of us who own a home that now has that interest rate, we're selfishly very happy with that. Yes, Michael's doing a thumbs up, myself included. That's great for me personally. Terrible for the way I make my living, right? Because it froze the market, right? So again, this is the challenge, is from a government standpoint, in order to avoid short-term pain, we created long-term pain, right? So now we just have to live through the repercussions. And by the way, for those of us who are willing to get out there and do the work and take our unfair share of business that exists, right? These dips in the market are opportunities. Because I will tell you this also, it is the folks who are most committed to their business, treat it like a business, and show up and work every day. They take an unfair share of business, especially when it's hard. Especially when it's hard, right? That whole 80-20 rule, that 80-20 rule turns into like a 90-10 rule when the market's hard. The best people take the business, and best doesn't mean been doing it the longest, right? Somebody young, hungry, willing to learn, and willing to put in a day's work every day can come and take it also. So it's not how long have you been doing it. It's just the people who are willing to show up, be professionals, and be fully committed. They take more market share during those timeframes. That 80-20 shifts and it gets even higher, right? So again, this is all stuff to know. And I personally don't think, we all know. Do we know somebody, and maybe you're one of them, whose business is up when the market's down? Right? It happens. Absolutely happens, right?
Usually, when I had my own boutique office, I told agents, look, we don't make the most money at the top of the market or at the bottom. It's when things change.
Mm-hmm.
Because whether people are moving because they're doing great or they're moving because they need to find a new job, it's the number of transactions accelerate.
Yeah. So Michael, it looks like it was you. That's a good footnote that Michael put in the chat. Ray Dalio has a book about the history of economics. Ray Dalio, by the way, anything you can listen to or read that is Ray Dalio, if you want to get smart about historical trends, understanding historical trends to predict future trends, Ray Dalio is on the money. And for the most part, he can explain things in layman's terms, right? One of the best videos I've ever seen on how the economy works is a YouTube video called How the Economic Machine Works. He explains it in super blue collar language that you can fully understand. Oh, this is how the economy works, right? And there's value in understanding those things. So thank you for putting that in. Anything Ray Dalio, I would strongly encourage. All right, so mortgage rates. Here's the other thing. There's a story. Everybody's locked up because everybody has a sub 3% rate. Not true. Number one, we have the highest percentage of people who own their homes outright. than we've ever had in the history of the country. For those who do have mortgages, this is where they fall. 20% of the market is locked in 3% or less. 31% of the market is 3 to 4%. Right. So sub 3 to 4% makes up 51.5% of the market. That's a lot. So half. And that's people who have a mortgage. Because again, right now, there are more homeowners that own their homes free and clear than ever in the history of the United States. Those people are not stuck in a mortgage situation. If they want to sell, they can sell. They have the cash to buy cash, or they have the cash to put a lot of money down where the rate becomes less relevant. So if they genuinely want to move, they're in a position to be able to do it, should they choose to. It's going to be circumstantial based on their life. Go ahead, Michael.
The problem with that is they're going to get killed in capital gains.
Well, that depends. That depends if they've lived in the house for the time period necessary and the value of the home. Yes. Yeah. So most people at this point have enough equity where they are getting hit with capital gains regardless. Now, again, there is conversation about changing what that limit is for the capital gains, which I think is a very smart conversation to be having, because it hasn't changed in I don't know how long, but a very long time. So if that number was relevant when that rule was put in place, the number is not relevant to today's market based on home values. I think it would be a very smart thing for them to modify that number. And that would absolutely help inventory. If all of a sudden homeowners knew the first million in profit instead of the first 500,000 for a married couple was tax free, that would open up some doors for people to sell, right? And coming back to this, 17% are 4.5, 4 to 5%, 10% are 5 to 6%, and the highest percentage on the right hand side of this pie chart and the fastest growing chunk of the pie is 6+%, right? 21% of homeowners who have a mortgage rate that is above 6%. This whole half of the pie, I would argue, is not trapped by rate. Maybe the very, very bottom, the 4%er, may still be looking at a 2% increase and making a financial decision rather than a life decision. But even that's a maybe. After that, this half of the pie, the rate's not affecting them to the degree that it is on the other side of the pie. So, and again, the pie that's going to grow the fastest is the one that's already the biggest pie on the right-hand side, which is the 6+, right? It's that 6+, and if rates do tick just below, right, you're going to start to see this 10% grow, but it's going to be at the top. It's going to be the high fives, right? So this entire pie is continuing to grow. That's the pie we need to see to return to normalcy. Right, all those new homeowners who are coming in and buying houses, and they're buying them at 6.5, 6.8, 5.9, 6.2. Right, those are the people that 5 years from now, when the house doesn't fit them anymore, they can sell, and they will sell because there's no reason not to sell. Right, as that pie continues to grow, which it will, the rest of the pies as a percentage will shrink, and the more that happens, the more we return to a level of normalcy. Right, so keeping an eye on that stat matters. The bigger that pie is, the more normal our market becomes, the more inventory we have, right? And the more things start to flow and the bottleneck opens up again. So it's an important piece to pay attention to. Affordability, this is really important because this is a real number, right? This is actually what matters. So when we talk about interest rates and prices, I'm sure many of us, when prices were skyrocketing, had the rate conversation with folks, people who said, you know what, these prices are crazy. I'm just going to sit on the sideline for a little bit. If you heard that during that time frame, you hopefully said, wait a minute, we need to talk about the other side of that coin, which is interest rate. So yes, the price might be X amount more than it was 2 years ago, but rates being what rates are, the cost for you to own the house is actually less. And oh, by the way, there's nothing telling us that prices are going to slow down. Like they're going to continue to appreciate in the near future. And all signs point to rates are going to go up because they can't stay here, which means every day you don't buy a house, you have a very high likelihood that house is getting more expensive every day because the value is continuing to go up and the interest rate is going to tick up with it. Next thing you know, you're going to be paying top dollar and top rate. Those folks who didn't listen to that advice and decided to sit on the sidelines for a couple of years, they did exactly that. They ended up buying top price, top rate, right? So affordability, if you come down here, right, you can kind of see the trend, the norm. If you go across this entire time frame back to 1972, it's 27%. That means the average homeowner, it takes 27% of their income to afford the median sales price home in the United States. That's what that means. You can see the spike at the highest point in 1981, we got to 49%. You can see the low, 2012, right, which was the end of the crash. That was the end of the banking crash. 2012 was when things started to turn up again in most markets.
Matt, I know you're pressed for time,
Mhm.
but I got to ask about this. The 49%, that was right at the end of what you were talking about before with the oil issue.
Sure is.
Um, was that the oil issue, or was that Reagan coming into office and mixing things up?
So I don't know, to be honest. I don't know. What I would say is that is certainly a thing.
Hmm.
If what is going on right now continues to go on, that's a thing I wouldn't go down a rabbit hole on it,
Right.
but I would do some Googling or I would hit Chat GPT and be like, tell me about this period of time and tell me how it affected real estate and why.
What's Chat GBT? No, I'm just kidding.
um,
Sorry.
no worries, no worries. All right, so we went all the way down to 18%, and that was driven 100% by rate. Right now, here's the thing: when I go back to talking about stories and reality, in 2020 and 2021, when it dropped to its lowest level in this recorded history, which is a massive swath of time, the story was these prices are outrageous. There were buyers who, and by the way, there were young buyers. There were parents telling their young buyers, this is ridiculous, wait it out. There were people saying, this is ridiculous, I'm going to wait it out. I'm not going to sell because prices are crazy to buy rent. Like there were all these conversations happening. As a professional, this is what you have to be able to show people. Like, here's the thing, like, this is a math equation. And right now, you're only looking at one part of it. Like, X plus Y equals Z, and you're only looking at X, right? You have to look at the entire equation. And the reality is, affordability is the lowest it's been in recorded history, going all the way back to 1973. Yet, during that time frame, there was a story that now's not the time to buy because prices are crazy. Now, we all know what happened to the person who decided to sideline and didn't buy, didn't get all that appreciation, and oh, by the way, got a 6 or 7% rate instead of a 3 or 4% rate. Now, where are we at today? We went all the way up to 34%. 2025, we dropped down to 32%. So right now we're about 5% over the trend. So it costs 5% more of the average American's income to own the average American home than what is the historical norm, right? So we're a little over right now. And again, that is reality. That can help a conversation, right? For people to understand that, yeah, we're over. We're not as much over as you might think. Like historically, it takes about 27%. Like if you go all the way back into the beginning of the 70s, which by the way, you don't have to memorize all these numbers. You just need to know when to say them and use ranges. You go all the way back to the beginning of the 70s, it's about 27% is what most Americans had to spend in order to buy the average home. 27% of their income to buy the average American home. We are at 32 now. So it's a little high. We're 5% over. However, it's not 49, right? We just got to bring it into perspective. So I'm going to skip Canada. We're going to run through some, we're going to do this part fairly quickly. Unemployment, here's where we're at. Nothing really huge to discuss there. More unemployment. Again, nothing huge to accept. These two are crossing. We got to a weird place where this was backwards, right? So the amount of job openings was above the amount of unemployed people, which if you look historically, that's not the case. We're seeing those lines crossing and going back to a normal pattern. Job growth, very anemic in 2025. We normally measure job growth in millions. It was 181 jobs, 881,000 jobs added last year. So job growth is very slow. This does affect us because when job growth is slow, the economy tends to be slow. Consumer sentiment tends to be a little shaky. Those things affect the psyche of the humans that essentially create the economy. So these things can affect us. This just shows the sectors of where jobs are growing and not growing. It is very condensed, right? If you took out healthcare alone, we would have lost 500,000 jobs, right? If you took out leisure and hospitality, we'd be almost break even. You'd have 60,000 jobs gained, right? So the gain that we did have, as anemic as it was, is very condensed into specific industries. So something to keep an eye on because, again, those things can affect consumer confidence. Looking at wealth and income, right? The old saying goes, the rich get richer. The good news is everybody got richer and the rich got the most richer, right? So if you look at wealth and income, this breaks it down by income classes. The top 1% had 1,000% increase in their net worth. You go to the top 9%, 711, top 40%, 597% increase in net worth. To the bottom 50% had a 492% increase in net worth. So everybody's net worth is higher generally. And the greatest gains were at the top. No surprise there. This breaks it down into just your three categories: upper, middle, and lower class. Upper class as a whole, wealth increase of 148%, 70% for the middle, 46% for the bottom. This is a little interesting. Just take a look at it. It's a little bit fascinating. This actually shows at age 30 what the net worth was of each of these generations: baby boomers compared to Gen X, compared to millennials. This is interesting too, because again, stories. The story here is it hasn't changed much, right? We all know every generation thinks the next generation is useless and we had it harder than them and we're smarter than them and we work harder than them and all the things. Our parents said it about us, yada, yada, yada. Yet, like, if you look at financial responsibility here, it's actually pretty consistent, right? So as far as what their net worth is, their debt, all the things, it's been pretty stable from generation to generation. Inflation, right? We finally got inflation down to where they really want inflation to be, which is about 2%. So inflation right now looks pretty healthy. That could change drastically just based on the things going on. This is the thing we're most worried about when it comes to interest rates is inflation. There are some things that are bubbling that could negatively affect inflation, in which case that could either stop the decline of interest rates or could even start driving interest rates back up again, neither of which would be great for us. This is important. I'll go through it quick, but it is important. Whenever the Fed drops the rates, not everybody understands that when the Fed drops the rate, that doesn't directly affect mortgage rates. That directly affects short-term borrowing rates, car loans, credit cards, things of that nature. It does not immediately affect mortgage rates. Mortgage rates are more closely tied to the 10-year bond. That is actually what, and I'm not going to say it drives it, but they are very much tied together. So when the Fed does a cut, if the Fed cuts the interest rate by 0.5%, that doesn't mean mortgage rates drop by 0.5%, right? It's important to know and understand that. Now, if you look at these two, you can still see there's a trend. Like, they follow the general trend, not always, but historically, with a lot of short-term bumps up and down, right? But there's a general curve that follows it, but it's not immediate, and it doesn't necessarily follow it, a point at a time. So it's related, but they're distant cousins, I guess is a good way to say it. Then we get to the treasury yield, right? There's very much more direct relationship. And just a number to understand to try to simplify things. Typically, the difference between mortgage rates and the yield of a 10-year treasury, which is basically like what you get paid if you own the bond. So if you own a 10-year bond, you're basically loaning money to the government, and the government says, we'll pay you this much money to let us keep your money for 10 years. That's the yield. That is very much related to mortgage rates. Typically, and you see these arrows here, typically the gap between the 10-year bond yield and mortgage rates is between 1.5% to 3%. Right. So if you look here, you see 1.78, 1.9, 2.92, 2.96, 1.9, which is where we are now. That's about normal. 1.5 to 3 is usually the gap between a 10-year bond yield and the actual interest rate. So again, these are important things to know and understand, because these are things most of your consumers do not understand. Right. If they're in the middle of getting a mortgage and they hear the Fed just cut the rate by 0.5 point, most people think that means their interest rate is immediately going down, and it's just not true, right? Consumer sentiment. This is the last slide I'll hit on. Then we'll touch on just like a couple of things to pay attention to that could affect the market in the future. At that point, we'll be at noon. If you have any questions, you can ask them, and if you need to jump, you can jump. This slide is shocking. So this is consumer sentiment as a whole. Right. So this is just the confidence of the American people in our economy. It is extremely low right now. 100 is what they consider historically normal. We are at 56.4%, which is extremely low. As you can see, like there's been very few times, right? During the pandemic, we dropped down to 50%. Outside of that, the sentiment has not been that low, like during this time frame, which is a fairly short time frame, but that's extremely low. That's not the alarming part, though. This is consumer and sentiment specifically about purchasing a home. 17%. That is shockingly low. That means the sentiment almost exclusively, like the majority of the US population believes now is not a good time to be buying a home. That is a story that we need to know how to unwind. That is why understanding these conversations and being able to share them in a simple way, right? When someone says it's just outrageous, we can't possibly afford a house. Nobody can in this market. To be able to say, I know it feels that way sometimes because we got a lot of appreciation in a short period of time, but the reality is, in our market, we're only 5% over what the average sales price should be right now, just based on historical norms. And, it's usually 27% of an American's income that is needed in order to buy a home. It is up a little bit right now, but it's actually up by 5%. That's the average. And right now we're at 34 or whatever that number was. Being able to have those simple conversations, because this sentiment is not in alignment with reality. There is a story that our consumers believe that is causing them to believe you should not buy real estate now, telling people you should not buy real estate right now. That is a story that needs to be fixed. Now, I always try to find the fact, and then I also, because I like to be a realistic optimist, I always try to look for the silver lining also. Like, what's the danger? And then where can I find a sliver of sunshine? If you look at when it's dropped to its lowest, they tend to rebound pretty quickly. And I think that's largely because often, like, this isn't about fact. This is about feelings. This is an actual economic trend that is tracked, followed, and 100% influences the market, but it's not actually a real thing. We're tracking how people feel, right? And I guess the upside is, as human beings, our feelings tend to jump all over the place. And this actually shows that. So I look at this and I go, okay, well, when we've hit our lows, this goes back all the way to 1961, right? We're at the second lowest it's ever been recorded. We've seen it rebound pretty quickly, right? And then it's sort of, you kind of see a trend here. Like this, to me, if you drew a line across each one of these, is to me the more relevant information, because what's in between are just dips, like short dips. So after the biggest dip, looking at this history, we've seen it come up pretty quickly. So hopefully we'll see the same there. Last thing, and I'm just going to do this really fast. I'm not even going to go into the details. These are the things that we need to pay attention to that could affect real estate, right? Policy volatility. There's a lot of changes in policy rapidly that messes with markets and messes with consumer confidence. Those are things we have to pay attention to. Weakening labor market. Again, we only added 181,000 jobs. We normally measure that in millions, not hundreds of thousands. If that continues, that could be concerning. AI market corrections. There's a tremendous amount of money being invested in AI right now. Those of us who were around during the dot-com bubble, there is a concern that that market is overinflated and makes up a huge chunk of our stock market right now. So there's concerns about that. People are watching it. Inflation, right? If inflation, it is at a healthy spot now, but if that starts rising again, it could create challenges for us. Interest rates go back up. And geopolitical, right? When this presentation was created and presented, there is a risk of conflict in specific areas, being the Middle East and South America. Well, we're in the thick of a conflict in the Middle East right now. If that wraps up quickly, hopefully the impact will be minimal. And that's a terrible thing to say about a war because we've already lost 7 people. So the impact is never minimal. I'm just saying on the economy. And if it lasts long, it could be a factor. So those are the things that economists are paying attention to with relation to how it might affect our industry in 2026. So that was fast and furious. It is 12:05. Does anybody have any questions before we jump? Questions, comments? Everybody good? Going once, going twice? All right, so my advice would be look at those stats. By the way, if you're a KW agent and you go to Command, go to Connect, go into Command, click Connect, search Family Reunion 2026. These slides will come up. I would encourage you to download them and figure out of these slides, what are the ones that I need to know this stat for my own market? I would argue that's average sales price compared to what the average sales price would be with 4% appreciation. So we know the difference. Are we above the natural trend? And if so, by how much? That affordability factor, right? What is the median income of my area? And what is the median sales price home? So what is that number in my area, right? There's stats like that we need to know to make sure when we're having conversations, they're factual and we're not just feeding stories. Because right now, based on that 17% of people who think buying a home is a good idea right now, we need to correct the story. We need to be the people out there who know the facts and know how to communicate them simply so that we can correct that 17%. So that's it. Thank you for joining us. And I believe we're on for next week. If not, you'll get a notification. So we will see you on the next call.